I definitely want today's video to be what the title suggests, which is evaluating whether or not we can actually get to new all-time highs in this stock market on a logical basis anytime soon. However, before that, we've obviously gotten a very important CPI data release today, and it was hotter than expected. So why is the market green? And does this make any sense? Well, let's evaluate what I have identified as the prevailing argument for why the market is up and why, at least to some, expectations of additional Fed hiking this year have fallen despite the hotter than expected inflation rates across both headline and core. In my opinion, the activity we're seeing today is lunacy, and lunacy by people who choose not to listen to the Fed. And believe me, they are out there. That's why we were making so much money last year. That's why we've been able to predict continued Fed hawkishness this year, even while SVB was going on. We watched Vice Chair Barr talk about the potential for banks to fail and non-banked institutions also to need higher capital requirements weeks, if not months, before SVB actually occurred. But when that recording was happening live, there were only a few hundred people worldwide tuning into that live stream. Very important, it turned out to be, live stream. So, don't put all your faith in these professionals. Don't put all your faith in these experts, okay? We're all human, we're all mortal. We will all make mistakes, even myself. So, my opinion, the activity we're seeing today is lunacy. So, what's the prevailing argument? The prevailing argument is that shelter inflation has finally begun to cool. And therefore, the inflation rate isn't so hot. Because if you just assume that energy is everything and look at everything excluding energy, it's not too bad. Well, I think this argument has a serious problem because the bulls have been talking about, and the inflation is falling like a rock, people have been talking about for many months, that, the Fed isn't calculating inflation properly. They've been trying to say the Fed doesn't even calculate inflation properly because they don't calculate the housing component properly, okay? The Fed has heard this. The Fed has known this. For many months, the Fed has been saying, for many months, they anticipate that housing inflation will come down towards the end of this year. They've been saying that all year, essentially. So why, now that the argument is that, housing inflation is finally coming down in the data, after that has been thoroughly anticipated by the Fed, after that has been thoroughly claimed to be miscalculated by the people who are now making that claim and are now saying, now it's in the data, so now all of a sudden it matters, when they were saying it wasn't in the data before and it mattered then. Why all of a sudden, when we otherwise had hotter than expected inflation data, does it become the dominant force? This so-called, so perfectly understood, perfectly predicted single component of the inflation data, why is this the overruling fact? And the truth is, this is lunacy. This is hysteria and just total wishful thinking by the same people who have been wrong on inflation the whole time, by the same people who have been wrong on the Fed the whole time. There's a lot of them. This is the consensus view. This is what we're dealing with. This is why I was up 120% last year while the market was down 20%. I've fought this. I've seen this. I know what this is all about. However, when you actually listen to the Fed, you listen to Powell's testimonies to Congress, you listen to the people who ask him questions, who try to poke holes in him, what is the most important metric of inflation to him? Core services X housing. And guess what? What was core services X housing in July? 0.2% month on month. What was it in August in the inflation we just got? 0.5% month on month. That's a pretty high number. You annualize that, that's 6%. You look at what the Atlanta Fed said today. Let's not forget, the Fed members are in a blackout period. We have a meeting next week. They have all these trimmed means and these ways of calculating inflation. And guess what? They have color-coded categories, like 6. They're all in the hottest color-coded category, color code red. So I don't know why these people are trying to spin it. These wishful thinkers are trying to spin it. But I'm looking at yesterday, you have Jamie Dimon and you have JP Morgan saying stocks are disconnected from reality. And then you have one other team saying that, oh, the Fed is done. Goldman Sachs said the Fed, and I will post this link. You want this link? I will send it to you. I will happily send it to you. I will fucking run around sorority houses naked with the link of this tatted on my dick to this link. Goldman Sachs says the Fed is done after SVB fails. Guess what? The Fed has hiked what? 2 or 3 more times since? They themselves are projecting that they're going to hike one more time. And if you ask me, the Fed has gotten more hawkish. Are they going to hike more than one more time? I don't know. There's plenty of Fed members who think that they're going to hike more than one more time. Okay, that's a reasonable possibility. I think they've gotten more hawkish, but they're getting more hawkish in the sense of very few, if any, cuts next year. They're just going to push those farther back because the economy has been stronger, or whatever we want to call it, whatever it is, the Taylor Swift effect. I don't know. We'll leave that as an open-ended question at the end of this video. But that's how I think about the Fed. That's how I think about the CPI. Let's look at core services ex housing. It's not just energy. That's picking up. Guess what, though? Energy is going to trickle into everything else. So I think these people who are celebrating today are just lunatics. And honestly, I don't want to say this because I know there's plenty of times people could say it about me, but I don't think these people deserve a job on Wall Street. I don't think they do. If I'm fucking screwing these people in the ass, they're just gonna screw themselves in the ass. That's what I think. So that's on the CPI. Now to the title of this video: can we get to new all-time highs anytime soon? Because that's what these people expect. Here's the thing: we've been flat for 2 years. However, I think the environment we saw at those highs when we had the average return for the S&P 500 7%, okay? And we had a lockdown economy, and we were posting tremendous gains, tremendous growth. And that was somewhat warranted. In that environment, I'm not saying that kind of stock market behavior was unusual, because it wasn't. When you have a Fed that is actively printing the most money in history, of course financial assets are going to go up. When you have a Fed buying financial assets, and the biggest single buyer of financial assets, the Federal Reserve was the single biggest buyer of financial assets during COVID. You're going to get the price of financial assets to go up. That's what's going to happen. When you lower interest rates to the zero lower bound, at the same time that you have historic fiscal stimulus, you're going to get financial assets to go up. You're going to get high earnings growth. And that's exactly what happened. That was the exact Goldilocks picture that we had at those highs. We had the Goldilocks financial asset backdrop. We had an easing Fed, actively buying historic levels of assets, actively printing money, interest rates, the federal funds rate at the zero lower bound. We had tremendous fiscal stimulus and fiscal spending. And most importantly, the largest companies in the world had fundamentally experienced tremendous, perfectly planned, or not planned, but perfectly laid out fundamental growth in a pandemic economy. These tech stocks absolutely benefited from the lockdowns, from the stay-at-home, from the work-from-home environment. And some still have some of that. They are still growing, but others, particularly Apple, which is the largest, is now back to its pre-pandemic trend of shrinking revenues, lengthening iPhone upgrade cycles. They do have some good service growth. Maybe they can get something going there. Just saying. But it's normalizing. The economy is normalizing, and we're not going back to that pandemic economy, to those 0% interest rates definitely anytime soon, to that Federal Reserve buying money. Actually, what they're doing is shredding money. They bought all that debt. Now that debt is being paid back. They are receiving those debt payments, $80 billion a month, and they are shredding that money. That money is leaving the environment. So, at that high, we had the highest growth rates. We had printed money. We had 0% cost of capital and a TINA trade. There is no alternative. Now you have interest rates approaching the average rate and the average return of the S&P 500. And sure, at some point the Fed will do slight cuts. But they're not cutting to zero. They're not cutting to those low levels. It's a high question how interest rates are going to compare to where they've been since the great financial crisis. Foreign central banks have said they're going to be higher than they've been in the last decade plus. Our central bank, obviously, very important central bank, has chosen not to go there yet, but they have chosen to wonder about this question, be open to the possibility that the neutral rate will in fact be higher, and that interest rates will in fact be higher. That's just the way it's going to be. That's the way it has been for all of history, except for the period where the Fed was actually in the market buying securities, propping up massive deficits, and all this just total craziness. So now we're going to have money supply lower, interest rates higher, no longer having the absolute Goldilocks pandemic economy and tremendous fiscal stimulus. And let me repeat that again. Money supply lower. Actual money in existence lower. So to think that we're just going to get to new all-time highs when the forward earnings multiple of the S&P 500 ex-COVID is at the highest in the last 10 years already right now is a little crazy to me. I see plenty of reasons for that not to be the case. And this is the open question. Do earnings begin to accelerate from here as delinquency rates accelerate, as unemployment ticks up, as inflation rebounds, as energy prices go up, as the ability for companies to, quote, take price goes down? Are all these things going to play out in perfect harmony and perfect unison like they always do? Is that really, I'm kidding there, okay? Is that really going to be the case? Are earnings, as the market currently projects, as are in those forward multiples, of which are the highest of the last 10 years ex-COVID, and ex-COVID just skews the whole average picture. So it's a really interesting position that we're in right now. That's why JP Morgan yesterday said, or at least not JP Morgan, some analysts at JP Morgan said that stocks are disconnected from reality. Is this all going to come? Is this all okay and we go to new all-time highs? Well, that's an open question. Are we going to have a recession? That's an open question. The future's uncertain. I'm not 100% certain. I think that there's going to be continued economic slowdown for a lot of the reasons I just mentioned, but I don't know with 100% certainty. We've discussed what signs of economic uncertainty are present, and I have a thread as my pinned tweet on my Twitter at Billy LeBoot. You can go check that out. And we also have some videos titled Signs of an Economic Slowdown or Signs of a Recession that you can go ahead and watch that will articulate these ideas. I'm also happy to answer any questions at any time. And please like and subscribe to these videos so we can grow, so we can get bigger, so we can do more. That's today's video, and until next time, peace out.